The stock market has been breaking brand new all-time record highs in 2024 after worries of a recession and market crash in 2023. Now, there are two main reasons why the stock market has been booming in 2024, which I'm going to talk about. But these new highs in the stock market have kind of created this dual opinion in the stock market. Some investors are loving it, and they're saying the stock market is going to continue to boom like this in 2024. But then on the other side, you're starting to see more and more people start to get worried as to whether the stock market rally is actually sustainable. Now, to understand this, you have to understand the two reasons why the stock market has been booming, especially recently. The first reason is many investors are hopeful that the Federal Reserve Bank will start cutting interest rates in 2024 to kind of stimulate and boost the economy even more. And the second reason has to do with the American consumer, because the American consumer has been resilient. They've been strong, they've been spending money, even if they don't have money to spend, even if they're drowning in credit card debt. Americans are still spending money, which is keeping the economy growing, even though there's been a lot of worries about the debt that we've been seeing in our economy. So now, let's explain what this means and jump a little bit deeper. And just so you know, the reason why I have this background is because I'm currently in Tennessee working on some projects here. And the second thing I want you to know is that on February 6th, I'm hosting my first ever workshop on building wealth. It's called the 2024 Wealth Building Workshop, and I'm going to be going over different things that you can start doing today to start budgeting and to start systemizing your wealth, to start investing to generate cash flow, and how you can build a system to build wealth for yourself. This is a completely free workshop. It is a virtual workshop, and I'm going to be doing it at two different times on February 6th. I'm going to do it February 6th at 10 a.m. Eastern Time, and then February 6th at 8 p.m. Eastern Time. Both of these are going to be live, both of them are free, and both of them are virtual. So if you'd like to join me on these free virtual workshops to learn how you can start systemizing and building your wealth for 2024, I got the link to how you can join me down in the description below. But now let's jump into what's going on in the stock market. Starting with the Federal Reserve Bank and interest rates. The reason why interest rates play such a big part in the stock market is kind of twofold. First, when it comes to businesses, we have the largest pile of corporate debt than ever before. And the reason why that matters is because corporate debt is not a 30-year fixed rate mortgage. Corporate debt is a readjusting mortgage. And in 2024, we're going to start to see this new tidal wave of corporate debt start readjusting. We'll see even more in 2025, but this readjusting kind of wave begins in 2024. And so you have a lot of corporations sitting on the edge of their seats wondering, what's going to happen with interest rates? Because the interest rate that they pay is going to impact their expenses. And if interest rates stay elevated for longer, that means corporations are going to see their debt payments go a whole lot higher, because pretty much every person, every entity, everybody out there was refinancing their debt in 2020, 2021, and even into 2022 when mortgage rates and interest rates were at their lowest levels ever. And so now when you have interest rates significantly higher than that, you have to expect that if debts start to readjust, corporations are going to have to pay more money, and that could impact the profitability for many companies, especially the zombie companies, which are companies that are actually not making any money. So that's the first part of interest rates. The second part of interest rates has to do with the valuation of these companies, because a valuation of a company is a very subjective thing, meaning it really just depends on what another person, an investor, thinks a company's worth. And when an investor has easy access to cash, if there's free money floating around, if debt is cheap and there's a lot of dollars out there, investors are going to be willing to pay more money for investments. They're going to be willing to provide higher valuations because, well, they have more money to spend. If you don't have money to spend, you're going to be much pickier as an investor. And if you're pickier as an investor, you're going to really think twice before you give a company a exorbitantly high valuation. And so when it comes to something like the stock market, well, if interest rates stay high, that means investors, institutions, banks have to pay more money to borrow money. So if you go out and you take on margin, you're going to have to pay more money when interest rates are higher. And that means less money is flowing into the markets, because now investors, all kinds of investors, retail investors, regular people, and big institutions have to make smarter investment decisions because they need higher returns to justify the added risk and the higher cost. And that kind of pulls down valuations. Versus when interest rates are lower, Now it's kind of a free-for-all because if you're paying 3% on your debt, you only need a 4 or 5% return on your money to justify an investment. But if you're paying 7 or 8% to borrow money, now you need a 10% return to justify your investment. So it's a very different investment play, which is how your interest rates can play a big factor in things like the stock market, because number one, it impacts businesses, their profitability, their health, but it also impacts the valuations of businesses, which is directly seen on the stock market, because higher stock prices can also mean higher stock valuations. The second thing you want to pay attention to is the American consumer. Let me give you a quote from the chief economist of the National Retail Federation. This is what he said after holiday spending towards the end of 2023. What he said is, quote, "Consumer spending was remarkably resilient throughout 2023 and finished the year with a solid pace for the holiday season." Now let's think about what that means. The American consumer was remarkably resilient. What does that mean? That means the American people are spending money like crazy. And this is happening despite the fact that inflation has been outpacing wage growth. This has been happening despite the fact that credit card debt is at the highest levels ever. This is happening despite the fact that car payment numbers are at the highest levels ever. This is happening despite the fact that student loans have restarted. And this is happening despite the fact that most Americans don't have $1,000 in their savings account. So you have all these people that are kind of struggling financially, yet Americans are spending money like crazy. So what does that mean? Well, that means businesses are making money. That means stores are still selling stuff. And that means people and businesses have the ability to continue generating profits, but it comes at a price. It comes at the price of people spending more and more money that they might not have. Now, that's great in the short term because that means businesses get to continue making money and making profits. But there's got to be a point where people can't keep spending, right? And this is that big question where people are predicting and trying to guess and trying to wonder if that will ever happen. And the real answer is yes. I mean, there is a point. I mean, if you keep spending money faster than how you generate it, eventually you're going to hit a breaking point. No one knows when that breaking point is, although you have some banks and institutions saying that the breaking point is going to happen sometime in the middle part of 2024. But this is something you want to pay attention to, because what we've been seeing happen for the last number of years is that spending has been increasing faster than incomes. Not to mention the fact that inflation has been growing faster than many people's incomes, except towards the tail end of 2023, which was when, according to the reported numbers, wages were finally growing a little bit faster than inflation. And not to mention the fact that debts are at the highest levels we've ever seen. So now the question is, what is going to happen with the American consumer in 2024? Because what we saw through the end of 2023 was that Americans were spending money like crazy. Well, if Americans continue spending money like crazy, that's going to be good for the economy. That means businesses are making money. That'll be good for the stock market. But eventually, there will be a breaking point. When? I don't know. But eventually, there will be a breaking point. When that breaking point happens, people will no longer be able to continue spending at the same rates as they were before. If people then have to cut back on their spending, and they have to spend more energy and more dollars paying off their debts, well, that means that businesses are making less money. If businesses are making less money, that means they're generally making smaller profits. If they're making smaller profits, maybe they become a less investment-worthy asset, and that could also impact valuations. Now, the reason why this matters, and the reason why I want you to understand this, is because I don't want you to be in the game of trying to time the market. That's not how you win as a stock market investor. The way that most people, the average person, will win in the stock market is by finding an index, whether it's the S&P 500 or finding some sort of thing in the stock market that they want to invest in, and I just keep throwing their money into the markets every week, every 2 weeks, every month. What I do, and I don't recommend what I do to anybody else. What I do is every Wednesday, I have a system where some money is pulled out of my checkings account and it's automatically invested into my portfolio of ETFs. You can look at ETFs, mutual funds, index funds, it really doesn't matter. You can pick what types of funds you want to invest in. I have kind of a broad array of funds. things like the S&P 500, the 500 largest companies in the stock market. I have some dividend paying funds. I have some emerging markets. I have innovation funds. So you can find what you like. But now every week, I'm just throwing my money into the funds, whether the market's up, whether the market's down. If the market's up, I'm winning because that means my investments are making more money. If the market's down, I'm also winning because then I'm going to increase my investments and I'm going to want to buy more. So that's how a similar strategy like this is how the average person can win. Now, if you want to be more involved, nothing wrong with that. This is where, again, you don't want to try to just perfectly predict and time the market, but rather understand the market. You want to make sure you don't overpay for your investments. This is where now you're looking for individual companies. Again, I'm not telling you what to invest in, but if you wanted to invest in, say, Amazon, you'd want to find when it's a good time for you to go out and invest in Amazon. What is a good price for you to invest in Amazon and how to actually purchase that stock. That's going to require you to do research on the Amazon Corporation. It's going to require you to do research on the Amazon financials. It's going to require you to do some research on what's happening in the earnings calls. How are they innovating? What are they doing? Should you purchase it? Now, again, you can pick which one you want to do. I do both. But the key here is not trying to perfectly time the market and waiting for the perfect day to invest, because the people that are waiting for the perfect day, the perfect time, the perfect price to invest are the ones that sit on the sidelines and get none of the gains. Markets go through cycles. Markets go up, markets go down. There's a saying in the investment world that bulls make money, bears make money, but pigs get slaughtered. And what that means is bulls, people who think the market is going to go up, they can make money. Bears, people who think the stock market is going to go down, they can make money too. But the people that lose money are the people that get greedy. So if you want to make money in the stock market, what you want to understand is you got to know your strategy first. Don't try to time the market. Second, invest smartly. Third, that means don't invest more than you're willing to lose. Don't go into debt to invest your money in the stock market, especially as a beginner investor. And then understand how you want to invest. Find your strategy. Find your opportunities. There's a lot of different ways that you can learn, but the key is you have to know what you're investing in and how you want to be an investor. That way you don't get caught in the hype, because the media is in the business of selling you emotion. They're trying to tell you that the world is either going to end or that nothing bad can ever go wrong. But there's always money to be made. You just have to know how you can get your share of the action. Now, again, I'll be going over some of these concepts in my wealth building workshop on February 6th. So if you'd like to join me, I got the link to how you can join me for free down in the description. But this is where I want you to understand, number one, what's happening, but then number two, understand how you can capitalize on opportunities that'll be coming your way.